Welcome to today's video. First, we'll unpack how to finance a $100,000 home improvement the smart way. Next, we'll compare fixed-rate loans to HELOCs, and then we'll show you how to protect your retirement while getting the space you need. Finally, we'll wrap up with practical steps, examples, and quick quizzes to lock in your knowledge. Here's our roadmap. First, we'll set the stage with the decision you're facing. Then, we'll compare financing types. After that, we'll focus on safeguarding retirement, followed by a readiness checklist. Next, we'll tackle the save versus borrow dilemma. Finally, we'll consolidate the key takeaways and recap. Before we begin, a quick disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Please consult a licensed fiduciary advisor, loan officer, or tax professional for guidance tailored to your situation. Now let's move into the core decision. Let's frame the problem. You're considering a six-figure addition of around $100,000. The most common financing paths are fixed-rate installment loans and home equity lines of credit. Some people consider tapping retirement accounts to avoid new debt, but that choice can undermine decades of compound growth. To make a smart decision, you need a sound financial foundation, a strong emergency fund, stable income, and minimal existing high-interest debt. With that context, let's compare fixed-rate loans and HELOCs. Here's the high-stakes comparison. Fixed-rate loans offer predictability. For example, at around 8% over 20 years, you lock in a steady payment, which makes budgeting easier. In contrast, a HELOC often starts with a lower rate, but because it is variable, payments can increase if overall rates rise. HELOC borrowing power is strictly tied to your home equity. If your equity is limited, you may not be able to secure a full six-figure line. Above all, resist tapping retirement accounts for short-term convenience. Those dollars are meant to compound for decades. Let's compare side by side. A fixed-rate loan locks your cost, simplifying long-term budgeting and minimizing rate risk. You'll pay both principal and interest from the start, and the term is clearly defined, which suits stability-minded borrowers. Meanwhile, a HELOC can begin cheaper but carries meaningful rate risk. Payments may jump as interest rates rise, and many HELOCs allow interest-only payments during the draw period. Access to funds is also capped by your available home equity. HELOCs can be useful for shorter projects or when you need flexible draws, but they require stress testing against higher rate scenarios. These sample numbers illustrate payment behavior. A fixed-rate loan at around 8% over 20 years yields a predictable monthly payment of roughly $836 for 240 months. In contrast, a HELOC during an interest-only draw period would be about $542 at 6.5%, $792 at 9.5%, and $1,000 at 12%. Exact terms vary by lender, fees, credit profile, and your equity. The key is to stress test HELOC payments at rates 3 to 5 percentage points higher to ensure you can handle rate volatility. Now, let's test your understanding. Quiz time. Which option exposes you to the most payment risk if interest rates rise? A. Fixed-rate loan. B. HELOC. C. Paying cash. D. Short-term personal loan. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. HELOC. Variable rates mean your costs can increase as market rates climb, so your monthly payment risk is higher than with a fixed-rate loan. Protect your future. Avoid using retirement accounts to fund home projects. For example, $100,000 invested at a 7% annual return for 25 years grows to roughly $542,000. Even if a loan costs around 8%, the expected long-term returns from diversified retirement investments typically outpace that cost over decades. That opportunity cost is massive. Keep retirement dollars invested and use appropriate financing instead. Now let's do a quick check. Second quiz. You are decades from retirement. Should you tap your Roth IRA to avoid an approximately 8% fixed loan for a $100,000 addition? A. Yes. B. No. C. Only a small dip with plans to repay. D. It depends only on tax bracket. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. No, keep retirement funds intact. With decades to compound, the opportunity cost of withdrawing retirement dollars is substantial and can far exceed the cost of borrowing. Before taking on a large project, verify your readiness. Ensure an emergency fund of at least 8 months, stable income, and minimal high-interest debt. Stress test your budget for variable rate scenarios by adding 3 to 5 percentage points to a hypothetical HELOC rate. Confirm your equity and borrowing capacity to cover the full scope plus contingencies. Gather at least 3 contractor bids to establish realistic budgets and prevent scope creep. Compare lenders for total cost, including points, fees, and prepayment policies. Finally, plan for optional extra principal payments and potential refinancing if rates fall. Now let's weigh saving versus borrowing. If you can accumulate $100,000 in 4 to 5 years, paying cash can be the safer route, avoiding roughly 240 payments of about $836 and a total cash outflow of about $200,640. The trade-off is waiting for the space you want. Alternatively, consider a hybrid approach. Break the project into phases, borrow a smaller amount, and make targeted extra principal payments to shorten the payoff period. Next, let's visualize a sensible timeline for the financing journey. This timeline starts with pre-project preparation, assessing readiness, simplifying your debt picture, and building at least 8 months of emergency reserves. Next, in the first 1 to 2 months, you obtain multiple bids, finalize the scope, and set a 10 to 15% contingency. You then shop lenders, compare fixed loans to HELOCs, stress test variable rate scenarios, and lock a rate if choosing a fixed loan. During months 2 through 8, the build phase proceeds with milestone-based draws and inspections. After completion, you stabilize cash flow, rebuild your emergency fund, and enroll in autopay. Over the next 1 to 3 years, you make extra principal payments and watch the market for refinance opportunities. Between years 3 and 5, you can optionally refinance if rates fall and reassess your long-term goals. To recap the essentials: prioritize fixed-rate financing if you value stability. Do not fund projects by tapping retirement accounts. The compounding loss is too costly. Only assume large, long-term debt after confirming a strong financial buffer and a realistic plan. Finally, remember that HELOCs are constrained by your home equity and carry variable rate risk that must be stress tested. In summary, fixed-rate loans offer predictability, while HELOCs offer flexibility with meaningful rate risk. Protect retirement savings to preserve compounding. Ensure financial readiness with strong reserves and stable income. If you can save quickly, paying cash may be superior. If you do borrow, consider phased work or extra principal payments to reduce risk. Finally, let's close with a quick thank you and a request. Thank you for watching. If you found this helpful, please like the video, share it with someone planning a renovation, and subscribe for more practical finance content. Tell us in the comments how you're planning to fund your project and what you want to learn next.